month, Life Insurance Strategies Group is in Mexico. And specifically today, we're in Mexico City in Parque, Mexico. And for a long time, people have been asking me my opinion of premium financing. So financing life insurance premiums where you use the life insurance policy as collateral. And my views on premium financing really haven't changed over the last 20 years. And there's really a good, bad, and ugly parts of premium financing. And let's talk about that today. So let's talk about the good in premium financing. So obviously this is where a prospective policyholder goes out, arranges for financing of the loans for their policy, and then the policy is used as collateral. And this goes back, I'm not going to argue, some people say, it goes back to like the 1950s where a community bank, made a loan. But I think we really saw premium financing take off in the U.S. probably around 2010. But going back to the year 2000, I was heavily involved in premium financing in Asia, the Middle East, and Latin America, where a client's private bank was in the transaction. So this is important. So this is where I thought premium financing probably worked very well. And I'm not sure I feel the same way today where how it's used in the US. So back in those days, around the turn of the century, I was running a distribution for an insurance company that would distribute universal life policies through private banks to very wealthy people around the world. And how premium financing worked there was that the private bank said to their client, look, you've got at least $30 million of investable assets with us. So we're talking about very wealthy people here. We're not talking about high earners. We're talking about people that have at least $30 million of investable assets at a private bank. So they probably have several private banks in Hong Kong or Singapore or Dubai or Miami for Latin America. And that bank says to them, okay, if you want to buy this policy, we'd rather keep your cash invested earning a higher rate of return than what's in this policy. So we're going to loan you the money for the policy at a preferred rate, 75 basis points or 100 basis points plus LIBOR at the time. Before SOFR was used, it was LIBOR. Right, so that's a very great, fantastic rate. And under those conditions, premium financing worked very well. And even as the UL rates began to drop in the first 10 years of this century, that was still a fantastic model. Now that's the good. Let's talk about kind of the bad. So as we move into the US, this is where we have a different model for premium financing. Right? It's not so much the person's private bank or that they have $30 million of cash. Now we're talking about people that have a lesser net worth, where this begins to maybe not work so well. Where I do like it in the US is if a family is maybe illiquid. They have their money in real estate, it's earning, or investments where they're high, like maybe alternatives where they're getting a very high rate of return, above 10% return, maybe even 10% after taxes. And the people have at least $20 million of investable assets. So this tells me they're sophisticated. So premium financing still fitting there. I don't have a problem there. But when we begin to see, interest rates decline in the policies, the crediting rates, the dividend rates, we see interest rates moving up in the U.S. and we have third-party lenders involved. So we have not the person's private bank, but outside lenders coming in. Now the math's not working as well. And we begin to move into this area of high earners. So dentists, doctors, accountants doing premium financing as a part of retirement income. We're getting up there on the risk scale. So that's the bad. Now, the ugly. Now we're getting into the use of indexed universal life. We're getting into products that can be volatile, up and down, that aren't quite understood by the end client. And we're layering in the premium financing element. So we're taking all those good components and removing them. We have people that don't have a really substantial net worth. So people with under $20 million of investable assets. This tells me they're not as sophisticated. We're layering on third-party lenders. So this isn't their private bank giving them preferred rates. This is a retail lender giving them a retail loan. And now we're adding on sophisticated products that aren't fully understood. So I don't like to see premium financing under those circumstances. So you've heard my views today, the good, the bad, and the ugly on premium financing. They've been this way for years. It shouldn't surprise anyone. I'm happy to have discussions about it. But remember, at Life Insurance Strategies Group, we don't sell products. We help our individual and institutional clients evaluate the need for life insurance and then run that transaction on their behalf. And if we can help you, reach out to us at lifeinsurancestrategiesgroup.com.